Warren Buffett is a financial icon, and with good reason. His investing success is nothing short of legendary. It's said that he started his investing career at the age of 11 with a mere $100 or so to his name, but by age 19, that $100 had turned into $10,000, thanks both to his savvy investing and his side hustles like delivering newspapers door to door. By age 30, he was a millionaire. By 37, a decamillionaire. And in 1985, by the age of 55, his net worth was estimated at $1 billion by Forbes. You know what else Buffett is? An anomaly. Yeah, this is going to be one of those party pooper videos because while financial success is something that I believe is well within the reach of the vast majority of people, soaring to the rarefied air of Mr. Buffett is statistically improbable. And even though there are definitely a lot of valuable lessons we can learn from Buffett's story, trying to mimic his success, or any other sort of unrealistic investing expectations, I'll just be using Buffett's track record as an example, as most investors are familiar with his story, may actually do us more harm than good. Let's discuss why that is, as well as something that most of us should probably be doing instead. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. One reason that trying to mimic Buffett's investing success, or other unrealistic investing expectations, could end up doing us more harm than good is that it may breed discouragement. When you get right down to it, there's a reason Buffett is so special. There are very few others like him in the world. While he hasn't achieved the absolute highest average returns over an investing career, the 20 or so % that he's estimated to have earned over his many decades of investing is well above the average return for individual investors. The reality is that it's highly improbable, statistically speaking, that any of us will manage to approach Buffett's level of investing success, even if we do manage to do quite well for ourselves. And if we're constantly trying to chase his shadow, our almost inevitable failure to live up to those wildly unrealistic expectations can become very discouraging. And when people are discouraged, they tend to make decisions that they later regret, which I'll come back to in just a second. So instead of trying to live up to those unrealistic expectations, what most of us should probably do is to compare ourselves against ourselves and keep an eye on how we're progressing towards our own self-set financial goals. After all, that's the progress and those are the outcomes that we're going to have to live with. Those are the things that matter. A second reason that trying to mimic Buffett's investing success, or again, unrealistic investing expectations in general, could end up doing us more harm than good is that doing so may lead us to making choices that we later regret. In the context of trying to invest as successfully as Buffett, the two things that come to my mind immediately are the potential for taking unnecessary risks and the potential for giving up, which can be a very tempting decision to make if we're discouraged with our progress. Again, Buffett is an anomaly. What he's managed to do with his investments, through whatever combination of luck and skill you want to attribute to it, is nearly unprecedented. And it took a fair bit of risk to produce those outcomes, whether in the form of leveraging his investments, or buying more focused investments like individual stocks, or, as he eventually became famous for, taking on troubled and undervalued companies that nobody else wanted. Obviously, these risks paid off for him more often than not, and often in very big ways, but that won't necessarily be the reality for most investors that take the same high-risk approach. I mean, if Buffett's outcomes were the norm for risky investments, they wouldn't be considered risky investments, and everyone would want to get in on them. It actually reminds me a bit about the infinite monkey theorem, where if you had an infinite number of monkeys working on an infinite number of typewriters for an infinite amount of time, eventually, through pure chance, they would type out the complete works of Shakespeare, and every other work for that matter. A similar, albeit less extreme thing happens in the investing markets over time. Think about just how many investors there are putting money into the stock market. There are some 330 million people in the US alone. Roughly 258 million adults per the US Census data. Not all of them have money put into stocks, but many do, at least at some point in their lives. And then, at least with the US stock market, there's also a bevy of international investors pumping money into the system. Some investors are passive investors, through and through. I'm one of them. They invest in index funds and leave it at that. But many try to beat the market with a more active approach, at least with some portion of their investing money, even if it is only the portion that they consider to be their fun money. With that many investors trying various market-beating strategies, eventually, some of them are going to go on a crazy and extensive winning streak that allows them to accumulate millions or even billions of dollars. Another way of thinking of it is flipping a coin. On any given flip, the coin is just as likely to land on heads as it is tails. But if you flip it enough times, eventually you're going to get tails 4, 5, or 6 times in a row. That's kind of like what happens with some extremely successful investors. Through some combination of luck and skill, they managed to string together a bunch of winning stock picks and become fabulously wealthy as a result. But just because that's true, it doesn't mean that it's even remotely close to the reality for most individual investors. As we've seen in previous videos, and as you can see from Morningstar's semi-annual reports on the subject, well over half of active investors fail to match the markets once costs are taken into account. And these figures only get worse as you look at longer time horizons. For instance, according to Morningstar's most recent report, at least at the time of this writing in early December 2021, over the past 20-year period, from the summer of 2001 to the summer of 2021, active investment managers beat their market index funds anywhere from 8 to 18% of the time once costs were taken into account. And the success rates didn't get much better over a 10 or 15-year time period either. That means that roughly 8 to 9 out of every 10 professional money managers fail to beat the markets over the long haul, which just doesn't sound like very good odds to me given that I am not a professional money manager who invests for a living. And then if you take into account the possibility of something coming up which forces you to make a decision that you otherwise wouldn't, such as a margin call forcing you to sell your leveraged investments when they're down, or losing your job, or getting an unexpected bill which you need to cash out some of your investments to cover, then the likelihood of achieving extreme amounts of excess benefit from these riskier strategies becomes even more suspect. Again, that doesn't mean that achieving great returns using these approaches isn't possible, because of course it is, look at Buffett or Bitcoin millionaires. It's just that statistically speaking, it isn't the most likely outcome for individual investors. And because we only live once, it's important that we choose the path that's most likely to get us to the place we want to be the first time around. As a side note, it's also worth keeping in mind that Buffett began seriously investing at the age of 11, like I said before, which is not the norm for most people. And what's also not the norm is that he continued seriously working and investing for the next 80 years. Due to the miracle of compound interest, the majority of his roughly $108 or so billion net worth was earned in those additional investing years that most people never have. Had he, like most people, started investing in his mid-20s or even early 30s and retired in his mid-60s, his net worth would be significantly less than it is today. Even assuming you or I did manage to earn the roughly 20% average annualized return Buffett is said to have produced in his lifetime during a more normal 30 or 40-year time horizon, our net worth would not come anywhere close to Buffett's. A $10,000 investment growing at 20% per year for 40 years comes out to be worth around $14.7 million when all is said and done. A $10,000 starting investment with ongoing yearly contributions of around $26,500, which is the amount it takes to max out a 401k and IRA for those under 50 in 2022, comes out to around $248.2 million after 40 years. To put those figures in perspective, that's less than 1/4% of Buffett's estimated net worth today. So you could really argue that the most important, and shockingly underrated, factor in Buffett's financial success is not the investments he picked, but the fact that he's been picking them for so gosh darn long. It's longevity and consistency, not foresight, that's driven the bulk of his accumulation of wealth. And that's crucial to remember because, as another side note, as we've covered previously on this channel, it's been found that investing returns are often skewed at both the individual and market-wide level. In a pair of studies conducted by Professor Hendrik Bessembinder, it was found that roughly 4% of stocks accounted for the entirety of the market's excess returns when compared to the risk-free rate provided by short-term treasury bills. It's also worth noting that the best returning investments of any given year tend to be one-offs that don't repeat themselves very often. You can see this by looking up the best returning stock from each calendar year yourself. I've compiled the top 10 highest returning stocks from the past couple of years using data from the Motley Fool in this chart. So, in summary, trying to mimic Buffett's investing success, or again, any unrealistic investing expectations, may lead to discouragement and eventually giving up on your investments altogether, especially if you hit a particularly bad rough patch early on. It may also lead to you making riskier decisions than you normally would in an effort to chase those fast-moving goalposts. Technically, these risks can pay off. And as we just saw in the last chart, they can pay off in a big way. But that isn't the most likely outcome that most investors making those decisions are going to experience, either because the investments and the markets they exist within are skewed, external circumstances force their hand in one way or another, or just the fact that which stocks are hot and which stocks are not changes on a regular basis, which makes the proper timing of trades more important and increases the difficulty of sustaining investing success over the long haul using those higher risk approaches. Remember, if these abnormal normally great results were the expected outcome for most investors choosing this path, we wouldn't consider those decisions to be the risky path to wealth, and we probably wouldn't even consider their outcomes to be noteworthy enough to report on the news or in blog posts or YouTube videos. But because there are so many people taking these paths with either part or all of their money, there's bound to be some major success stories. And since those success stories do make for really engaging headlines, they tend to get more media coverage, which can paint a less than realistic picture of how likely and easy it is to stumble your way into millions in the short term. The thing we need to keep in mind is that we only live once. And while usually that is a phrase used to justify choices that tend to be a bit more on the reckless side of the spectrum, if taken literally, it can also mean that we only have one shot to get this right. So it's important to choose the path that's most likely to lead us to where we want to go. And when it comes to building and maintaining financial wealth, the biggest driving factor, even for the highly successful investors like Buffett, is usually going to be longevity and consistency, not a few good stock picks. So yeah, you and I are probably not going to be the next Warren Buffett. But that's okay. We don't have to be in order to reach our financial goals. And at the end of the day, those are the things we should really be striving to achieve in the first place. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.